On behalf of Hyland Financial Planning and Morgans, it's our pleasure to bring you our March quarter economic update. So while we'd certainly encourage you to watch the full economic update in the link provided, Will Hickson from Morgans is with me to give us a brief synopsis of this update. So Will, with the Federal Reserve, which is the equivalent of our Australian Reserve Bank, having just raised interest rates, will that actually be the focus of this update?
Yeah, that's right, Justin. So the US Federal Reserve has just lifted interest rates, and any future rate rises will have major implications for global share markets. So US economic growth continues to pick up, as does the outlook for inflation. And even after this last rise, their official rate still sits at only about 0.9%. So if we're going to return to what would historically be considered more normal interest rate levels of say 3%, that's possibly as many as 9 interest rate rises over coming years. So that's quite significant.
That's certainly significant. Then what would be the ramifications for shares globally if the US Fed Reserve keeps raising their interest rates?
Yeah, so look, Will Douglas goes into more detail on this in the update. But on the plus side, if interest rates are rising, that means inflation is rising as well, and that's generally a good thing for shares. Probably best to think about it this way. So if you're out there in the market, you want to buy a car, and you see that the price of cars is rising at a more at a greater rate than you'd expect, well, you're going to purchase that car this year rather than leave it in next year. So that's good for business in the short term. Even though we're seeing that as a positive broadly, it wouldn't surprise us to see a fair degree of volatility around each individual rate rise as they come through. So I suppose we're expecting a bumpy ride as well.
So with that, are there certain sectors that would benefit over others with these rate rises?
Yeah, absolutely, Justin. So rising interest rates and rising inflation will be good for some sectors and businesses, and there'll certainly be others that will struggle under that scenario. So looking at the positives, so rising inflation should be good for more cyclical businesses, like resources, for example. And they've had a really tough sort of 4 or 5 years. On the flip side, rising interest rates would see the higher yielding but lower growth sectors like property, infrastructure and telecommunications, they could struggle going forward. But Will goes into far more detail on this in the economic update.
Yep. And Will, recently we've spoken to clients about the fixed interests in their portfolios and the new fixed interest coming to the market or the issuance. Is that discussed in this update as well?
Yeah, absolutely, Justin. So look, we've been concerned about the possibility of significant amounts of new fixed interest notes coming to the market. And really what we were worried was that some of those new notes would put pressure on older, lower margin notes. So what we've recommended generally is the sale of those older those older notes to the lower margin, and Will goes into more detail again on that one.
Okay, wonderful. Thanks for that, Will. So this investment update really is to the core of our service offering. It's 1 hour each quarter spelling out our key investment messages, and it's really important to us that you tune in and watch the update, as by not doing so you may be missing some vital information. It would also greatly assist with your ongoing financial education. So it's important to understand that the elements of this economic update and this particular video are of general advice in nature, so they're not specific to your personal circumstances. If you have any questions or concerns, or you read something in the major daily papers, or you see something in the news, please don't hesitate to call us, and we can sort of set the record straight for you. And all the best, and we'll talk soon.